Imagine getting into your electric SUV after a really long day at work.
Yeah, you're just completely exhausted.
Exactly. You sit down, the doors close, and the car already knows you're heading home.
No buttons pressed,
Right, without you pressing a single button. It just communicates with your house automatically.
which is pretty wild to think about.
It really is. It turns on your living room air conditioner, dims the lights, and preheats the smart oven in your kitchen.
All perfectly synced up.
Yeah, and here is the real kicker. Every single piece of that technology, the car, the AC, the oven, and the smartphone in your pocket, it's all designed and manufactured by the exact same company.
And we are definitely not talking about Apple here.
No, we aren't talking about Apple, and we aren't talking about Tesla either. We are talking about an entirely different kind of beast.
It's just a level of vertical and horizontal integration
Yeah.
that, frankly, the consumer electronics market has never seen before.
Never.
I mean, it is the absolute obliteration of traditional product categories.
And that is exactly our mission for this deep dive today. We are taking a massive stack of analyst reports from places like China Renaissance, GF Securities, JP Morgan, and some independent researchers.
Some really comprehensive institutional research in there.
Oh, massive amounts of data. And we're using all of it to evaluate Xiaomi's epic transformation.
Because they are trying to evolve from just, a high-volume smartphone manufacturer into this interconnected, multi-platform tech behemoth.
Right. And to do that properly, we have to look at what we're calling the triple cycle.
Yeah, the triple cycle. We really need to dig into the mechanics of their supply chain costs, the intense competition they're facing, and obviously shifting consumer demand.
Because right now, the global financial market is severely divided on how to actually value this company.
Completely split down the middle.
Which brings us to the big question we're answering for you today. Is Xiaomi's currently compressed valuation a dangerous value trap?
Like a shiny gadget that just distracts you.
Exactly. Or is it a generational buying opportunity?
It's the multi-billion-dollar question.
It really is. But hey, before we jump into the deep end, I do need to mention that this deep dive is brought to you by iMaps Capital Markets.
Right, which is very relevant for today's topic.
Definitely. And we should note that Xiaomi shares are part of the iMaps investment universe, meaning asset managers and traders may include the shares in their portfolios as an underlying of iMaps Capital Markets actively managed certificates issued at EWOC Stuttgart Exchange.
Yeah, that's important context for you listening at home, especially because this stock is heavily traded by institutions globally.
Oh, absolutely. And the volatility we've seen recently is just, well, extraordinary is one word for it.
Brutal might be another word.
Brutal is definitely accurate. Let's set the stage for you. If you pull up a stock chart for Xiaomi right now, ticker 1810 in Hong Kong, it literally looks like a roller coaster that lost its brakes.
Yeah, it's not a pretty picture.
Over the last 12 months, the stock suffered a massive 58.8% correction.
Almost 60%.
It plummeted from this euphoric peak of HK $59.46 in late 2025, all the way down to HK $21.42 by mid-2026.
Just a massive evaporation of market cap.
Yeah, billions of dollars just vanishing. So to understand that crash, we have to look at what caused the peak in the first place.
Exactly. And that late 2025 high, it was driven by pure market euphoria surrounding their electric vehicles.
Specifically the YU7 SUV series, right?
Yeah, the initial reception was explosive. The market just started pricing them like the next global EV dominator.
But the reality of scaling a car business is incredibly messy.
Oh, it's a logistical nightmare.
Yeah.
So to figure out where they're actually going, we have to establish what Xiaomi's business model truly is today.
Which they call the human times, car times, home ecosystem.
Right. And I love that you said times because it sounds like a mathematical equation.
When it does, and that is exactly how management wants you to think about it. It's a multiplier effect.
Okay, so what is the connective tissue making all that math work?
It's their proprietary operating system, HyperOS.
HyperOS. Yeah, you simply cannot analyze this company as a phone maker anymore. HyperOS is the digital architecture that lets the phone, the smart home appliances, and the EV all share one unified software platform.
So if I'm an analyst, right, and I'm just sitting at my desk counting how many millions of smartphones they shipped last quarter.
You're completely missing the plot.
I'm just looking at the trees and missing the forest.
Exactly. If you only count the hardware, you misunderstand how they plan to generate long-term cash flow.
Okay, I hear that. But let me push back a little bit here.
Okay.
Even if the smartphone isn't the whole story anymore, it is still the historical engine of the company, right?
Definitely. It's the anchor.
It's the device that gets you into the ecosystem in the first place. So before we go look at the shiny electric cars in the garage, we really need to pop the hood on that smartphone division.
We do.
Because my understanding from reading these reports from China Renaissance and JP Morgan is that the smartphone engine is facing a massive existential threat right now.
It is facing a historic margin squeeze. And honestly, the most frustrating part for management is that this threat is entirely out of their control.
Wow, really? Entirely?
Yeah, the core foundation of their hardware business is just colliding head-on with a global memory cost supercycle.
Okay, let's break that down for the listener, because memory cost supercycle sounds like a lot of dense financial jargon.
It does sound a bit academic.
When we talk about memory in a smartphone, what exactly is getting so expensive and how bad is the price hike?
We're primarily talking about two types of components here: DRAM and NAND flash memory.
Okay, DRAM and NAND.
Think of DRAM as the short-term working memory of your phone. It's what lets you have 20 apps open at once without the phone just crashing.
Right. And the NAND flash.
That's the long-term storage.
Yeah,
So where your photos, the operating system, and all your downloaded movies actually live.
got it. So what's happening with the prices on those?
According to the supply chain data in these reports, the cost of these memory components has skyrocketed by over 400% since September 2025.
Wait, 400%.
Yes, 4 times the cost.
That is astronomical for a physical component. I
Yeah.
mean, if I'm building a house and the price of lumber goes up 400%, I either stop building or I charge 4 times as much for the house.
Exactly. The margins just evaporate.
Why is this happening? Did the global supply chain just break down again? Like during the pandemic, did
Okay.
factories shut down?
That's a great question, but no, this isn't a pandemic-style collapse. The factories are running just fine.
Oh, they are.
Yeah, the issue is who they are selling the chips to. It's a structural shift in global demand.
Okay, so who's buying them all?
Well, the global memory market is dominated by a few massive suppliers. The big three are Samsung, SK Hynix, and Micron.
Right, the heavyweights.
And right now, those suppliers are locking in massive multi-year agreements with global cloud providers, the hyperscalers.
So we're talking about the Amazons, the Googles, the Microsoft.
Exactly. These hyperscalers are in an absolute arms race to build out massive AI server farms to support generative AI.
Yeah, and I'm guessing AI server farms need a lot of memory.
An unfathomable amount of high bandwidth memory. So if you're Samsung and you have to choose between selling chips to a cloud provider building $1 billion data center.
Or selling them to a consumer electronics company making mid-range smartphones.
Right. Who do you prioritize? You go with the hyperscaler every single time.
Because the enterprise AI market is vastly more profitable and probably more reliable than the fickle consumer phone market, right?
Precisely. And this dynamic has created a massive supply bottleneck for consumer electronics.
It's just sucking all the oxygen out of the room.
And the JP Morgan research highlights that this isn't a short-term blip either.
Oh, it's not.
No. They predict that DRAM and NAND prices are going to jump another 40 to 60% quarter over quarter in just the second quarter of 2026.
Another 60% on top of the 400%.
Yeah. And because of those long-term contracts with the cloud providers, these high costs will likely persist through 2027 and 2028.
Wow. So the era of incredibly cheap memory that fueled the whole smartphone boom of the 2010s, that's just officially over.
It's completely dead.
So put yourself in the shoes of Xiaomi's executive team for a second. You're sitting there trying to manufacture millions of smartphones, and the cost of one of your most critical internal organs just quadrupled.
It's a nightmare scenario.
How do you actually survive that without bleeding cash? I was reading the China Renaissance report, and it looks like Xiaomi took a pretty drastic approach.
They did. Very drastic.
They actively curbed their low-end smartphone shipments in the first quarter of 2026. They intentionally let their volume drop by about 20% year over year.
They just pulled back.
But somehow their smartphone gross margins remained unexpectedly resilient at 10.1% in that same quarter.
Yes, and that 10.1% was actually a significant beat. JP Morgan originally modeled that margin dipping down to 9.5% because of the memory costs.
Okay, so how did they beat the model?
Xiaomi protected that margin by driving a record high average selling price, or ASP, of RMB 310.
Okay, let's unpack this for a second because it feels counterintuitive to me.
Sure, go ahead.
If Xiaomi is intentionally cutting its own smartphone volume by 20% just to protect their profit margins, aren't they effectively strangling their own customer acquisition funnel?
That is the exact risk.
Right, because it's like an airline pulling all the economy seats out of their plane so they only fly business class just because jet fuel got too expensive.
That's a really good analogy.
Sure, the profit margin on the few business class tickets you sell looks great, but what happens to your overall market share?
It plummets.
Exactly. If you aren't getting millions of people into your ecosystem with an affordable phone, how do you ever expect to sell them the smart fridge or the AI subscription or the EV down the road?
It is a razor's edge they are walking right now.
Mm.
Historically, Xiaomi's entire identity was built on volume.
Right, selling a massive amount of hardware at razor-thin margins.
They just wanted the device in your hands so they could get you into their software ecosystem.
The classic race to the bottom on price to win market share.
But when memory costs jump 400%, the math of that strategy completely implodes.
It just doesn't work anymore.
Not at all. Selling low-end phones doesn't just mean thin margins anymore. It means deeply negative margins.
Oh, wow. So they'd actually be losing money.
If they maintain their historical volume on low-end Redmi devices, they would literally be losing money on every single unit shipped. And you cannot make up a negative margin with high volume.
No, you just bankrupt yourself faster.
Exactly. So they had to pivot.
But how exactly are they achieving this higher average selling price? Are they just slapping a higher price tag on the same old phones and hoping the consumer doesn't notice?
No, the consumer's way too smart for that, especially in China's hyper-competitive mobile market.
So what's the strategy?
They are actively shifting their product mix. They are delivering premium, AI-enabled handsets designed for a less price-sensitive consumer base.
Ah, okay. The flagship models.
Right. They are focusing their marketing and supply chain heavily on the flagship Xiaomi series, packing them with advanced camera systems and on-device AI capabilities rather than just pumping out budget devices.
But, I mean, this strategic pivot fundamentally changes the financial DNA of the company.
It really does.
Look at the numbers from the reports. The smartphone division's share of Xiaomi's total gross profit has absolutely plummeted. Over a 2-year period, it dropped from contributing 40.9% of total gross profit down to just 15.1%.
It is a staggering evaporation of what used to be their core profit engine.
Staggering is the right word.
And it requires a complete paradigm shift in how an investor views this stock. For a decade, analysts modeled Xiaomi primarily as a smartphone manufacturer.
Right. If phone sales were up, the stock was up.
But today, at 15.1% of gross profit, the phones are no longer the cash cow. They are just the gateway. They're the front door to the house.
Which begs the obvious question. If the smartphone division is getting suffocated by the memory chip cycle and it's only providing 15% of the profit, where is the other 85% actually coming from?
Excellent question.
How is this company keeping the lights on?
That leads us directly into the real financial engine of the company today. The artificial intelligence of things, the AIoT division, and the absolute margin magic of their internet services division.
Okay, let's get into the mechanics of that magic because the numbers here are wild.
They really are.
According to the research, the Internet Services Division is operating at an extraordinary 77% gross margin.
Yep, 77%.
That is software as a service level profitability. How are they achieving that on top of hardware?
They're achieving it through pure scale and captive monetization. Xiaomi currently has 754 million global monthly active users.
Think about that number for a second. 754 million human beings are interacting with the device running HyperOS every single month.
That is nearly 10% of the entire global population.
It's unbelievable scale.
And Xiaomi doesn't just sell you the device and walk away.
Yeah.
Through HyperOS, they monetize that massive user base via advertising displayed within the operating system, through revenue-sharing agreements on mobile gaming, and through proprietary digital services.
Plus the App Store cuts, right?
Exactly. App Store cuts are huge.
So wait, let's connect this back to our earlier discussion. A lot of analysts historically compared this to the Gillette razor model.
Right, the classic razor and blades.
You sell the razor handle incredibly cheap, which would be the Xiaomi smartphone, just to lock the consumer in so you can sell them the replacement blades at a massive markup.
Right.
And in this case, the blades are the digital ads, the App Store purchases, the gaming subscriptions, all running at that 77% margin.
That used to be the perfect analogy.
But based on what you're saying about HyperOS and the human times car times home strategy, the Gillette analogy feels, I don't know, a little too small now.
It is much too small.
Yeah.
The Gillette model assumes you're just locking someone into one specific vertical, shaving.
Right.
But Xiaomi isn't trying to lock you into a single product category. They are trying to lock you into an entire lifestyle infrastructure.
Okay, give me a better way to think about it then. How does this ecosystem actually work as an economic moat?
Let's compare it to gravitational pull. Think about Apple for a second.
Okay, the Apple ecosystem.
Apple's ecosystem is often described as a walled garden. It's beautiful inside, but you are kept in by high walls. iMessage blue bubbles, your iCloud photo library, your purchased apps.
Yeah, the friction to climb over that wall and switch to Android is a major annoyance, so most people just stay.
Exactly, the switching cost is high. But Xiaomi is building something more like a black hole's gravity.
A black hole, that sounds intense.
Well, the walled garden of Apple mostly just encompasses your screens, your phone, tablet, computer. Xiaomi's gravity pulls in the physical environment around you.
So extending past the screens?
Right. Let's say you buy a premium Xiaomi smartphone. Then, because the integration is flawless, you buy a Xiaomi split-type air conditioner. Then you get a Xiaomi smart TV and maybe their robotic vacuum.
Okay, so now I have a highly connected house.
Yes, but think about the psychology of the switching cost now. If you have an iPhone and you want to try a Samsung, you lose your blue text bubbles. Annoying, but manageable.
Yeah, you get over it.
But if you have a fully integrated Xiaomi house and you suddenly decide you want to switch your smartphone brand, your entire physical environment loses its central nervous system.
Oh, wow. I didn't think about it like that.
The TV stops syncing perfectly with your phone. The AC doesn't automatically adjust when you walk in the door. The friction of escaping that level of convenience, the gravitational pull of the ecosystem, it's just too high.
You literally cannot afford the behavioral headache of changing brands.
Exactly. And because that gravity keeps you trapped inside the ecosystem, you remain one of those 754 million monthly active users.
Which allows that internet services division to just quietly print money at a 77% margin in the background. It is brilliant.
It is brilliant when it works. But the hardware acting as the anchor for that gravity, the AIoT division, making the TVs and appliances, it isn't immune to macroeconomic reality.
Right.
They act as a profit buffer,
Right.
but they are dealing with their own demand shock right now.
Yes, the reports highlight a major hurdle they hit in the domestic Chinese market. China had implemented these massive purchase subsidies for domestic appliances to stimulate the economy.
A really aggressive subsidy program.
But those subsidies phased out in late 2025. And what happens when you tell consumers a discount is going away?
Everyone rushes to buy the appliance before the deadline. It pulls all the future demand forward.
Exactly. Analysts call it a demand cliff, and Xiaomi fell right off it.
It was a steep drop.
Because everyone bought their smart AC units and TVs in late 2025, Q1 2026 domestic AIoT revenue suddenly dropped 23.7% year over year. That is a brutal contraction.
It really hurts the top line.
So how is management attempting to plug that hole?
They are pivoting away from relying solely on the domestic Chinese consumer. Management is focusing heavily on overseas AIoT expansion.
Going global with the appliances.
Yeah, JP Morgan noted that while overall IoT growth was sluggish due to the China demand cliff, Xiaomi guided for double-digit year-over-year growth in their overseas IoT business in early 2026.
And the rationale makes sense. The reports cite that the total addressable market, the TAM, outside of China, is 3 to 4 times larger than the domestic market.
Yes, it's massive. But capturing that TAM requires immense capital.
Because they have to build out the infrastructure, right?
Exactly. They are investing heavily in offline retail channels and online distribution networks globally to get these appliances into European, Latin American, and Southeast Asian homes.
So we have the smartphone engine fighting a 400% memory cost surge. We have the home appliance division trying to recover from a 23% domestic revenue drop by expanding overseas. That alone is a massive operational headache.
Most management teams would crumble under just that.
But Xiaomi didn't stop at the living room. They decided to take this ecosystem gravity and extend it into the driveway.
The biggest gamble of all.
Which brings us to the most capital-intensive, high-stakes thriller of this entire corporate story, the smart electric vehicle business.
This is the ultimate wild card. The EV division is what drove the stock to HK $59, and the reality of the EV division is a major reason why it crashed back down to HK $21.
Let's walk through the timeline because the launch was nothing short of historic. The EV business had an explosive start.
Truly explosive.
They delivered 411,000 units in 2025, generating over RMB 100 billion in revenue in its first full year of operation.
Which is just, it's hard to even comprehend that scale.
For a company that was primarily known for making mid-range smartphones just a few years ago, spinning up an automotive manufacturing arm that generates 100 billion RMB out of thin air is staggering.
It shattered every early expectation. Independent analysts like Florian Muller noted that those 2025 delivery numbers far exceeded even Xiaomi management's most optimistic internal targets.
So the initial consumer demand for the SU7 sedan was just insatiable.
They couldn't build them fast enough.
But the narrative shifts dramatically when we look at the projections for 2026. The guidance for 2026 is noticeably softer.
Much softer.
Management is guiding for 550,000 total units for the year. And here is the massive red flag that JP Morgan highlights in their report. Between January and April of 2026, Xiaomi only delivered a little over 110,000 units.
Which is a big problem.
If you were trying to hit 550,000 in 12 months and you only hit 110,000 in the first 4 months, you are running well behind pace.
You are, but we have to dissect why they fell behind pace. This is where understanding the mechanics of automotive manufacturing becomes crucial.
Okay, break that down for me.
It wasn't necessarily a sudden collapse in consumer desire. It was a structural manufacturing bottleneck.
What caused the bottleneck? Did they run out of parts?
No, the sources indicate this shortfall was due to first half 2026 model transitions.
Okay, model transitions.
Right. Xiaomi had a facelift version of the SU7 sedan coming out in March, and they were simultaneously launching entirely new variants of the YU7 SUV series in May.
Including that high-performance YU7 GT model, right?
Exactly.
Okay, but car companies release new models all the time. Ford and GM do it every year. Why does that cause a massive delivery shortfall?
Because building a car is not like updating the software on an app. It is deeply physical.
Right.
When an auto manufacturer transitions to a new model or even just a facelift, they cannot keep the assembly line running at full speed. They have to physically retool the factories.
Oh, I see. What does retooling actually entail?
They have to change out the massive metal stamping dies. They have to recalibrate hundreds of robotic welding arms for the new chassis dimensions. They have to retrain the assembly workers.
So it's a huge operational pause.
Exactly. During that retooling period, the factory line slows down to a crawl or pauses entirely. You stop producing the old model, but you aren't yet at full production speed for the new model.
And while that assembly line is paused, the financial meter is still running.
Ticking away every second.
Which explains the brutal Q1 2026 earnings report for this division. The EV segment reported an operating loss of RMB 3.1 billion.
A massive hit.
The analyst reports specifically cite a temporary loss of operating leverage. What does that mean in practical terms for the business?
Operating leverage is all about the relationship between your fixed costs and your variable costs. In a car factory, your fixed costs are astronomical.
Because of the facilities and the robots.
Exactly. You have to pay the lease on the massive factory building. You have to pay heating and electricity. You have to pay the salaries of thousands of workers. And you are amortizing the billion-dollar cost of the robotic machinery.
And those costs exist whether you build one car that day or 1,000 cars that day.
Precisely. So when the factory slows down to retool for the SU7 facelift, your revenue drops off a cliff because you aren't delivering cars, but your fixed costs stay exactly the same.
That is the loss of operating leverage. Your fixed costs just eat you alive.
And to make matters worse, Xiaomi was enduring this retooling pause right in the middle of one of the most severe domestic price wars in the history of the Chinese auto market.
Let's talk about that price war, because this is where my skepticism really kicks in.
It's a bloodbath out there.
Are they biting off more than they can chew here? Building a car is a brutally complex, capital-heavy, logistically nightmarish industry that has bankrupted hundreds of companies over the last century.
It's historically a terrible business to be in.
And look at who Xiaomi is fighting in China. They're going up against heavyweights like BYD, Tesla, Geely, and NIO. BYD alone sold over 273,000 EVs in December 2025.
Just unbelievable volume.
These legacy automakers and dedicated EV giants are slashing their prices to the bone. They are perfectly willing to sacrifice short-term profits just to bleed out new competitors. Can a smartphone company really survive a multi-year war of attrition against BYD?
That is the multi-billion-dollar question. And it's the exact reason institutional investors are hesitant right now.
I mean, I would be hesitant too.
The entire thesis comes down to flawless execution.
Yeah.
Can they build these cars profitably while under heavy fire?
And can they?
Well, this is where the GF Securities and JP Morgan reports reveal a piece of data that is actually quite shocking in a positive way.
Okay, what is it?
Despite the intense price wars and despite the phase-out of local EV tax subsidies, Xiaomi's EV gross margin held remarkably resilient at 20.1% in Q1 2026.
Wait, let me make sure I'm reading that right. A 20.1% gross margin on a physical car
Yes.
from a company that just started manufacturing vehicles a few years ago.
It sounds impossible,
It
right?
feels suspiciously high. Legacy automakers like Ford or GM often operate on high single-digit or low double-digit margins. How is Xiaomi commanding 20.1% while in the middle of a price war?
It comes down to pricing power driven by the ecosystem and supply chain efficiency. First, their average selling price in the auto division is incredibly healthy. It's over RMB 235,000.
Because consumers want the high-end versions.
Exactly. Consumer demand is heavily skewed toward the higher-end Pro and Max trims of their vehicles rather than the base models. Consumers want the biggest battery and the most advanced autonomous driving features.
So they're selling the most profitable units.
Yes. And second, because Xiaomi has spent a decade building one of the most efficient consumer electronics supply chains in the world, they are leveraging those exact same supplier relationships and procurement strategies to drive down the cost of the digital components inside the car.
Okay. This circles back to our earlier point about the ecosystem moat.
It does.
Legacy automakers are selling cars to make a profit on the bending of metal and the assembly of parts. Xiaomi can theoretically afford to sell the car at a lower margin or pack it with vastly more technology at the same price because the car is just a giant rolling acquisition tool.
A rolling smartphone.
Right. To get you into the HyperOS software ecosystem, where they eventually make a 77% margin, that is a terrifying structural advantage if you are a traditional auto CEO.
It is absolutely terrifying. But having a structural advantage doesn't guarantee you can actually build the cars on time.
Execution is still everything.
Right. To reach that 550,000 delivery target for 2026, JP Morgan estimates that Xiaomi requires absolute flawless execution in the second half of the year.
What does that look like in terms of numbers?
They need to ramp the factories back up and deliver more than 55,000 units per month, every single month, in the second half of 2026.
Have they ever hit a 55,000 unit month before?
No. Their record monthly shipment was roughly 50,000 units back in December 2025.
Oh, wow. So they have to consistently exceed their all-time record month after month while transitioning to the new YU7 variants.
It leaves zero room for error. If there is a chip shortage or a battery supplier hiccup, they miss the target.
And the domestic Chinese market isn't the final frontier either. The analyst reports outline a massive long-term catalyst that the bulls are heavily focused on: international expansion.
Yes, Europe.
Xiaomi is targeting a commercial entry into the European EV market scheduled for late 2027.
But JP Morgan throws some serious cold water on that timeline.
Why? European consumers love EVs.
They do, but JP Morgan cautions that entering Europe is not as simple as just putting cars on a boat.
Right, you need infrastructure.
Exactly. You have to establish a massive network of localized sales centers, navigate vastly different regulatory and safety standards across multiple EU countries, and build out physical service and repair infrastructure.
That sounds incredibly expensive.
The capital expenditure required is immense. So JP Morgan believes the actual financial contribution from Europe in 2027 might be quite limited initially.
Okay, so let's synthesize what we have so far. We have the smartphone division fighting a brutal 400% surge in memory costs. We have the home appliances acting as a profit buffer, but trying to recover from a demand cliff by going overseas.
Right.
And we have the EV division burning cash on factory retooling while trying to scale up in a domestic price war.
It's a lot of spinning plates.
If you are going to tie a car, a house, and a phone together so flawlessly that the consumer doesn't feel any of this back-end corporate friction, you need a central nervous system that is incredibly intelligent.
You need AI.
Which brings us to a critical piece of the puzzle. How is Xiaomi leveraging the generative AI boom to make this ecosystem actually work?
Well, you simply cannot talk about a tech ecosystem in 2026 without talking about foundation models. AI is the glue.
And Xiaomi is apparently backing up the money truck to make sure their glue is the absolute best.
They're spending a fortune.
The financial reports show they are committing over RMB 16 billion strictly to artificial intelligence spending in 2026 alone.
Just on AI.
Right. And that is just one slice of an astronomical total research and development budget that is expected to exceed RMB 40 billion.
To put that in perspective, that R&D budget represents an implied year-over-year increase of over 20%. They are heavily outspending many of their peers.
But the question is always, are they getting a return on that investment? A lot of tech companies just slap the word AI on their press releases to boost their stock price.
Yeah, AI washing.
Exactly. But Xiaomi actually has tangible products in the market. They've launched the MIMO V2.5 Pro Foundation model.
Yes, Mimo.
And according to the Comprehensive Intelligence Index cited in the research, this model currently ranks first globally among open source large language models.
Having a top-ranked open source model is an incredible feat of engineering. But open source doesn't automatically equal revenue.
No, usually it means you're giving it away for free.
Exactly. So
Yeah.
what is fascinating is how they are choosing to monetize it.
Right, they aren't just giving it away. They have integrated an agentic AI called MyClaw directly into the HyperOS system.
Backlaw. Yes.
And they are monetizing it by selling what they call token packages, which range from a basic light tier up to a premium max tier.
Let's ground this in reality for the listener. What does this actually look like for a consumer? What does buying an AI token package mean for my daily life?
Yeah, how does it change how I use my phone?
Imagine MyClaw as a deeply embedded, highly proactive digital butler that lives across all your devices.
Okay, a digital butler.
If you are on the free or light tier, maybe MyClaw helps you rewrite emails on your phone or optimize your battery life.
Yeah.
But if you pay a monthly subscription for the max tier package, MyClaw gets access to vast computational power. It can analyze your calendar, notice you have a flight tomorrow, automatically pack your digital itinerary, preemptively route your EV to a charging station on the way to the airport, and turn down the climate control in your house the moment your car leaves the driveway.
Wow. So you are paying for a completely frictionless life.
Exactly. You're paying for time and convenience.
And apparently people are willing to pay for it. The data shows that the post-trial subscription retention rate for these AI features is sitting at 35%.
That is a very healthy conversion rate for a software subscription.
Very healthy. Even better for Xiaomi, the premium tiers, the more expensive packages, are making up over 50% of the revenue. Oh, and I can't forget they are also throwing a portion of that R&D budget at embodied robotic intelligence through a division called Xiaomi Robotics Zero.
Yeah, the robotics division is incredibly interesting from a technological standpoint,
Draw.
but from an investment perspective, it is strictly a long-term play. It's not moving the revenue needle today.
So let me play devil's advocate here, because RMB 40 billion in R&D is a massive drag on the bottom line.
It is a huge expense.
Is this massive AI and robotics push actually moving the financial needle for them right now? Or is this just a really expensive, shiny science project meant to distract investors from the harsh realities of their hardware business?
You mean a distraction from the smartphones and cars?
Yeah. Is management just pointing at the AI butler and saying, don't look at our crashing smartphone volume and our EV factory losses, look at the cool AI?
That is the exact debate tearing the analyst community apart right now. You have two very distinct camps.
The bulls and the bears.
Right. If you read Florian Muller's independent analysis or the GF Securities report, you are getting the strong bull perspective.
What is their argument? Why are they bullish?
The bulls view Xiaomi's AI investments not as a distraction, but as a massive multi-platform gateway that justifies a higher stock price.
Oh.
They argue that because MyClaw operates seamlessly across the phone, the car, and the home, Xiaomi has a proprietary data advantage that no other company on Earth has.
Oh, because they see everything.
Exactly. Apple doesn't know how you drive. Tesla doesn't know what you watch on your living room TV. Xiaomi knows all of it.
That's a ton of behavioral data.
The bulls believe this deep, recurring integration justifies moving the stock out of the low-valuation hardware manufacturer penalty box and into the high-valuation software and AI premium tier.
I can see the logic. If millions of people are paying a high-margin monthly subscription for a max-tier AI package to run their lives through HyperOS, that is exactly the kind of recurring software revenue that Wall Street drools over.
Exactly. It's high-margin, recurring revenue.
Yeah.
But then you flip over to the JP Morgan report and you get the stark bear perspective.
Okay, what did the bear say?
JP Morgan acknowledges that the AI model monetization and the robotics initiatives are great for the company's long-term technological health. But they argue that these software subscriptions simply aren't generating enough raw cash yet to offset the massive earnings drag in the core hardware business.
They are essentially saying the shiny new toys don't pay the electric bill for the car factory.
Precisely. JP Morgan actually forecasts that Xiaomi's adjusted core business operating profit will decline by 7% year over year in 2026.
Ouch. 7% decline.
Therefore, they argue that these AI projects, no matter how cool they are, will not drive a near-term re-rating of the stock.
Right.
They view that RMB 40 billion R&D budget not as a visionary investment, but as a heavy anchor that will keep the company's overall operating margins depressed at a meager 5% through 2026.
It's a classic battle between long-term visionary potential and near-term margin pressure, which brings us to the ultimate climax of this deep dive.
The final verdict.
We have synthesized the triple cycle, the memory cost supercycle squeezing the smartphone engine, the fierce price wars and factory retooling squeezing the EV business, and the demand cliff squeezing the home appliances. Now, we have to synthesize all of this into a final valuation verdict for you, the listener.
To do that properly, we must start with the bedrock of any company, the balance sheet.
And frankly, Xiaomi's balance sheet is a fortress.
It is incredibly strong.
Despite burning billions of RMB on AI research and building car factories from scratch, they are sitting on a massive net cash position of RMB 66.5 billion.
That is a lot of dry powder.
And their long-term debt is comparatively tiny, sitting at only RMB 25 billion. That means their net debt to EBITDA ratio, which is essentially a measure of how many years it would take a company to pay back its debt using its current earnings, is deeply negative.
Let's emphasize why that matters. In a macroeconomic environment with high interest rates, heavily indebted companies trying to build capital-intensive projects are getting crushed by interest payments.
Just absolutely suffocated.
But Xiaomi has zero solvency risk. They're entirely self-funding this massive pivot from smartphones to EVs using their own cash reserves.
That is a luxury almost no other hardware startup possesses.
It's a massive competitive advantage.
But despite that fortress balance sheet, the stock is still languishing at HK $21.42. To figure out if that is fundamentally cheap or fundamentally accurate, the analysts use a valuation method called sum of the parts, or SOTP.
Because Xiaomi is doing so many different things, you can't just slap one simple metric on the whole company.
Right. It's like trying to price a massive, sprawling farm. You can't just put one price tag on the whole property. To get an accurate value, you have to appraise the farmhouse, then appraise the tractors, then calculate the value of the crops currently in the ground and add them all together.
That's a perfect way to explain SOTP.
How do the different analysts slice up Xiaomi's farm?
JP Morgan separates it into two main buckets. For the core business, which encompasses the hardware devices and the highly profitable internet services, they assign a 12x price-to-earnings multiple.
Okay, 12x for the core.
For the EV business, because it is still in its hyper-growth scaling phase and is not yet generating pure bottom-line profit, they use a different metric, a 1.5x price-to-sales multiple.
Makes sense. You value it on revenue growth.
When JP Morgan adds those parts together, they arrive at a target price of HK $35.
Which, it should be noted, is still significantly higher than the current trading price of HK $21.42.
It is a nice premium. Now, GF Securities slices the farm up a bit more granularly. They assign a conservative 10x PE multiple to the hardware division because they're worried about those memory cost issues.
Right, the 400% surge.
But they give a juicy 20x PE multiple to the Internet Services division because of the massive AI subscription potential.
Valuing it more like a software company.
Finally, they assign a 1.2x PS multiple to the EV business. And if you look at China Renaissance, they're the most bullish of the group. They maintain a buy rating with a lofty target of HK $47.
And if we step away from the complex analyst models and just look at the raw cash the company generates, the trailing 12 months free cash flow yield sits at a highly undemanding 4.6%.
Which is very reasonable.
In simpler terms, that equates to roughly a 21x price-to-earnings ratio.
And context is key there. Historically, Xiaomi has traded at an average PE of around 24x. So on a purely historical relative basis, the stock is undervalued compared to its own past performance.
So we have all the data on the table. What does this all mean? For you, the listener who is sitting at home looking at your portfolio, staring at a structurally sound, cash-rich technology stock that is somehow down almost 60% from its recent highs.
That's a tough spot.
Is this a falling knife that is going to keep dropping because memory costs and EV price wars are going to eat them alive? Or is this the cheapest, most obvious entry point of the decade before the EV business scales up and takes over Europe?
It is time to deliver the objective iMaps visit.
The ultimate conclusion.
Right, drawn from synthesizing all these conflicting reports. When we weigh the data, the stance is neutral in the near term.
Neutral? Why not a screaming buy?
Because as an investor, you simply cannot ignore the immense gravity of the immediate headwinds. Yes, Xiaomi is a high-quality technology asset, Yes, they have a structurally sound fortress-like balance sheet that ensures they will survive,
Hmm.
but the operating environment over the next 12 to 18 months is highly, highly challenging.
Triple cycle is working against them.
Exactly. The memory cost upcycle is severe, and it is going to put a hard ceiling on core profit growth for the foreseeable future.
It caps their hardware profits.
Furthermore, while the EV business is a miracle of rapid revenue generation, it is actively burning cash on the operating line. They are fighting a brutal domestic price war, enduring factory retooling losses, and facing immense upcoming capital expenditures to prepare for the late 2027 European expansion.
The near-term margins are going to look ugly.
Very ugly.
So if I'm a tactical investor, what is the specific trigger? What do I need to see to change that neutral rating to an overweight or a buy?
Tactical capital allocation suggests you wait on the sidelines until two specific clouds clear. First, you must wait for the memory cost upcycle to stabilize.
Do we have a timeline for that?
Management has indicated we might see milder price hikes starting in Q3 2026. You want to see proof of that in the earnings reports.
Okay, so wait for memory costs to cool down. What's the second cloud?
Second, you must wait for clear, undeniable visibility on EV margin expansion. We need concrete proof that Xiaomi can exit this retooling phase, hit that 55,000 units per month run rate, survive the price war, and actually generate standalone profitability in the auto segment.
So they need to prove they can scale profitably under pressure.
Exactly. Until those two things happen, the stock lacks a distinct near-term positive catalyst to drive a massive re-rating. It is a phenomenal long-term story, but it is one that requires immense patience.
A phenomenal long-term story, but bring your patience. I think that perfectly encapsulates it.
It's the reality of a hardware pivot.
To briefly recap this incredible corporate high-wire act for you, Xiaomi is currently attempting to manage crushing 400% memory chip inflation in their historical core smartphone business by actively pivoting to a less price-sensitive premium AI device strategy.
Right.
At the exact same time, they are trying to scale a highly capital-intensive electric vehicle manufacturing empire from absolute scratch amidst a ruthless, margin-destroying domestic price war.
Which is just wild to think about.
And their grand master plan is to glue this entire operation together using hyper-profitable AI subscriptions and internet services running on their proprietary HyperOS architecture.
And they are performing this unprecedented high-wire act without the safety net of cheap debt, relying purely on their own internal cash generation. It is a breathtaking operational challenge.
It really is breathtaking. Before we sign off today, I want to leave you, the listener, with this final provocative thought to mull over.
This is the thing that really sticks with you.
We talked a lot about ecosystem gravity today. Think about the traditional moat of a dominant company like Apple. Their moat relies on getting you to buy a phone, maybe a watch, and a laptop.
Just a few screens.
And that limited ecosystem alone created a $3 trillion company. Now imagine the scale of the moat Xiaomi is actively trying to build.
It's exponential.
Imagine a world where the car you drive to work, the ambient temperature of the air you breathe in your living room, the oven cooking your food, and the digital AI brain anticipating your needs from your pocket all run on the exact same proprietary operating system.
Every aspect of your day.
If Xiaomi successfully pulls off this human times car times home vision on a global scale, at what point does the switching cost become so incredibly high that you literally cannot afford to change brands without completely upending and changing your entire lifestyle?
When it reaches that point, it stops being a simple consumer product choice. It becomes a structural life choice. And that is the ultimate competitive advantage.
Exactly. Thank you for joining us on this deep dive. We hope this gave you a clearer picture of the massive forces at play behind the headlines. Keep exploring the sources, always question the market consensus, and most importantly, stay insanely curious.